My name is Turan Bali. I'm a professor of finance at McDonough. I have a broad research interest in asset pricing, investments, and risk management, with special focus on equity and corporate bond markets. I am delighted to introduce our first panel today. Our moderator was Ben White. He is the chief economic correspondent at Politica. He is a next-door neighbor, Arlington, but he couldn't make it. I assume it's traffic, maybe. So Rina Agarwal will take over his spot. And we have three excellent speakers today. They will share their insight and views from three exchanges. Tal Cohen, Brian Harkins, and Nandini Sukumar. Tal is the executive vice president at NASDAQ. Brian is the executive vice president at CBOE, Chicago Board Option Exchange. And Nandini is the CEO of World Federation of Exchanges. Without further ado, I'd like to, they're already here. So, Rina, stage is yours.
Thank you. So, thank you, Turan. We just found out that Ben White can't make it here. He was actually on his way from New York and got delayed. So I'm going to try my best to moderate. But we have such a great panel here, such a great experience that this will be a great conversation. Let me start by just asking each of you to please introduce yourself and tell us a little bit about how life brought you to where you are from a career point of view.
I think you go first.
Sure. Well, first, thanks for having me. And an important clarification that Ben got stuck from New York, not Arlington. I was a little surprised to hear that. So I'm Brian Harkins. I've been at CBOE for a number of years. I guess I'm well-traveled in the exchange space. Actually, I was at NASDAQ, a bunch of exchanges before that, and been in the industry 20 years. My current responsibilities is I oversee our markets at CBOE, which is essentially our sales and competitive strategy for our equities, listed derivatives, foreign exchange businesses. So pleasure to be here.
Great. Tal Cohen, Executive Vice President at NASDAQ. I've been at NASDAQ for about 3 years now. My responsibilities include oversight of all of our transaction markets in North America. So that's fixed income, options, futures, and equities. And prior to NASDAQ, I was CEO of Chi-X Global. It was essentially a global startup where we brought up instances of exchanges all around the globe. And I got my start as a CPA, so I'm not exactly sure how I got here, but it's been a fun journey.
I'm Nandini Sukumar. I'm Chief Executive of the World Federation of Exchanges. We're the industry group for exchanges and CCPs, important to note because my member John Davidson is sitting here. We do what we say on the tin, as I always say. We do traditional trade association things. We work on policy issues. We advocate on behalf of our members. We have dialogue with policymakers, governments, and academia. We also publish a lot of, we work on research, typically on market structure issues that matter for our members. We do a lot of educational work as well. 50% of our members are from emerging or frontier markets, even while we represent all the large US exchanges and CCPs. We have about 70 members around the world. I say about because while we count at holding company level, they represent 300 market infrastructures. We represent 300 market infrastructures around the world, pretty much in every jurisdiction, where a third of our members are in Asia, a third are in EMEA, which is a region we classify not just continental Europe, but also Middle East, where we have 15 members, and Africa, where we have 8, and of course, the Americas, both in North America and of course in Central and Latin.
So let me start by asking, what are kind of critical issues that your organizations are facing from a market structure perspective or any perspective?
I can take a crack at that. So I think just taking a step back, what is the role of the exchange and what's our core mission? And it's always to provide the most liquid environment to allow for a seamless transfer of risk and really to get out of the way and make sure that there's not a lot of friction in the investing process. So we are literally at the end of the road of that investment process. We think about how do we keep our market makers and our liquidity providers happy so that they can provide more risk to provide, again, that transfer of risk when investors want to buy and sell in volatile times as well as on a day-to-day basis. When we think about that, technology is the tool that enables that. So we think a lot about scalability and making sure that we have robust technology. I'm sure Tal thinks of similar things, but we always thinking about how do we compete, how do we make sure we're on the bleeding edge of technology so that we can provide our customers and our liquidity providers with that seamless experience.
Yeah, just to add to that, so from a NASDAQ perspective, we think about capital formation, our role in the capital formation process, and obviously in helping entrepreneurs find investors, and then once they find those investors, helping those investors transfer that risk in a seamless way where we reduce friction in the marketplace. But for us, our journey starts even before then. So we have a private markets part of NASDAQ where we're talking to issuers about their liquidity needs, their governance needs, their cap table needs, before the public market ever sees these companies come to light. So there's a lot that we do on the private market side. Once they become public, we're part of this ecosystem that you described. And when I think about the ecosystem that Brian just alluded to, is we use our platform and our marketing muscle and our distribution capabilities to help entrepreneurs. And when we do that, we think very much about job creation and wealth creation, because that's the function of the public market. We are there to make sure that entrepreneurs can not only raise that capital, but create jobs and create the broadest sense of wealth creation.
So Tal, just to push that a little bit further, I know NASDAQ got into the private market business a few years ago. Give us a little more sense of what are you doing there and what are the plans for the future?
Yeah, so I think back in 2011 and 12, NASDAQ had the foresight to see that the private market was evolving. The private market's matured quite a bit. There's a lot of dry powder in the market. And in many cases, we're seeing companies delay going public or maybe never going public because of the amount of capital they're able to raise from the private markets. So from our perspective, we have this platform for private companies where we deal with private equity investors, the issuers themselves, where if they're looking for liquidity, we can organize liquidity in a transparent manner, provide governance and structure around that. If you need cap table management or other services as you're growing and maturing as a company, we just took note of that because we saw the private market space growing. We've done probably 80 to 90% of the big transactions over the last 3 to 4 years. And what we hope is these companies tend to graduate or think about graduating into the public markets. They get to know NASDAQ, our capabilities, and what we can bring to bear.
Nandini, you have a very interesting global perspective. You are dealing with members who are small and who are huge. What is the spectrum? What do you see? How are the needs different?
So that's a really interesting question. And basically, because I always describe, when I describe WFE, one of the things I say is well, you know, under N, we represent NASDAQ, the National Stock Exchange of India, and the Nigerian Stock Exchange. Under C, we represent Chicago Board Options Exchange, CME, Colombo, and the Colombian Stock Exchange. So really, when you look across the landscape, we always seek, because you can't do everything, so we seek always, you know, those common themes, of which there are plenty, Rena. So we have typically, we conduct our work via working groups. So we have 14 working groups. And then at any moment, every year, we kind of pick 5 or 6 topics that we think we need to, you know, focus our energy on. And we try to do a mix of, you know, what is the critical stuff that's staring us in the face. So for an example of that would be the conversations we're all having around market data. And I'm sure we will have some of those conversations at this meeting. But we also try to do a little bit of zeitgeist. We try to do a little bit of what is coming next. Because at the global level, you do need to be able to think about the future in a very fundamental way, in addition to looking at what's sitting on the plate in front of you. So for 2019, and I'm conscious we're talking about 2020 priorities at the moment, and we'll publish in January, but in 2019, for example, we decided that obviously the conversations around market data were a priority, as were some of the conversations around risk and capital requirements held at the CCP level And those actually are going to, I suspect, get more intense and will probably run over the next 2 years, actually. We decided that ESG, where the exchanges have been at the forefront of this issue, we've been working on it as an industry for over a decade. ESG's time is now. We've always spoken internally about at what point does ESG become mainstream, and both actually NASDAQ and CBOE, one a derivatives exchange and one an equity exchange, are both incredibly active on the issue. So we decided ESG, the time was now, and really if you look around the world in terms of the policy pipeline, we looked at technology. We always think about technology, but we decided that this year, last year we looked at cyber, and we continue to look at cyber, but this year we would think a little bit about some of the new market structures arising out of the new technology.
So let me pick up on a couple of issues you mentioned. Right? I'll start with ESG. And so what is the exchange itself doing on ESG? What are you pushing your issuers? How are you influencing the broader community on ESG issues? I'd love to hear your thoughts.
Yeah, so ESG is very topical. And so just to take a step back, our view on ESG is it's a major investment trend, investor trend. And there's mounting evidence that companies that embrace sustainability, embrace ESG over the long run will perform better. And they also have an easier time attracting and maintaining talent, especially millennial talent. And so that's the trend. And from our perspective, what's interesting is most of what we've seen to date in ESG is about selling solutions to the asset management community, which is very important, but we see a great opportunity to educate issuers and work with issuers on how to engage shareholders and stakeholders in a better way. So when we think about that, we are working with them to navigate and become smarter about embracing ESG. And what does that mean? Does it mean what disclosures should you be making? What best practices should you be following? Should you be putting out a green bond? And we're having all those conversations with these issuers. We think we're uniquely positioned to help them navigate that, provide them with solutions, and then create better, more sustainable companies that investors will find more interesting, and engagement with shareholders goes up at the end of the day.
So at Georgetown, we've been very active on the G part, the governance part, the corporate governance. And I would say that some of the leading research has come out of Georgetown on corporate governance. And the S is hard to deal with from a research point of view because the implications are very long term. In governance, the questions were about what has value implications, what aspects of governance matter, how do you influence governance around the world as institutional investors. We addressed a lot of those issues, and the researchers are very interested in the S, but it's just sort of difficult because it's so long term. But there's a lot of work coming out of academia on the S. Yeah. So another issue you touched on is technology, right? And let's start with cyber. Obviously a big concern, and I'm interested in how are you investing in that? What are you doing to counter cyber problems? Yeah.
I could take that. So very topical. Really important to regulators, really important to boards, really important to our customers. We all read about Capital One, Marriott, and if you haven't read, one of the things you should be doing with cyber is taking the lessons learned from everything that's happened out there with the Capital Ones and the Marriotts of the world. From our perspective, there are three core tenets when it comes to cyber and the way that NASDAQ thinks about it. One is the organization needs to be well-informed. You have to subscribe to information sharing. And actually, the financial services industry, we do a pretty good job of that, better than most. So if you see third-party surveys, financial services is way ahead of tech companies when it comes to information sharing. We have industry groups like FS-ISAC that allow you to talk and share any threats that you see or hear. So that's one. Two is it's about employee education. And so you have to embrace employee education. You have to make sure you have cyber training programs, phishing programs, and you're constantly updating employees on what to look for and how to educate them, because 80 to 90% of the key threats that we see are insider threats, meaning that employees, for one reason or another, have become susceptible. And the third is cultural, having good corporate hygiene. And so embracing it all the way at the top through all the layers of the organization. So we set up an office, that's a global office, around cyber, where it's responsible for all our policies, all our training, and we ensure that everybody from our board to our CEO to our executives are all part of the training process, so there's good corporate hygiene flowing downstream.
If I could just add to that, Rena, at the industry level, we actually have a cybersecurity working group at the WFE level, which is industries, it's practitioner specific, and it's really part of the industry's first line of defense against in cyber resilience. And really the trend has been to talk about resilience as opposed to, a zero fail regime, because, we are as technology has become the engines that modern markets run on, the policing or that cyber hygiene has become, a 24/7 burden and responsibility. So I think that at industry level, the exchanges and the CCPs are incredibly aware and alert of the need for cyber resilience, for good hygiene. I would say that there's a lot of commitment from the board level on. So if you say typically on an exchange panel, if you say to somebody what keeps you up at night, they'll say, oh, it's cyber and a cyber attack. A couple of years ago, we had a board meeting, and it was in Asia, as it happens, though we're based in London. And one of my board, it was a big exchange, wasn't, skipped part of the meeting, and we said, are you okay? He was on the phone a lot, and he said, well, we've had an outage, and, I'm half a world away. I'm 12 hours away, and I'm in touch. We haven't yet found the cause. We can't rule out cyber. And that was it. And in the end, he actually went back. It was a 12-hour flight, and he said, we still haven't found what caused that outage. It might be as simple, as a technological issue, but if I need to be back in case it is cyber.
Yeah, just one thing to add on that is, because you brought up a point that I thought was interesting. We run on an annual basis a crisis exercise where everybody in the organization is involved, and a lot of planning goes into it. And so there are people that design the script, and there are people that play the role of the market operators. And we will now almost 100% involve cyber as part of that crisis management exercise. So if something goes down and you don't know why, one of the first questions you ask, is it cyber related?
Yeah, the only thing I would add is just to Tal's point on really taking the seriousness of it, and it does start at the top, and really being adamant around training. So one thing that we do at SIBO is we do mock tests where, as Tal mentions, that a lot of it is insider. So we actually will have mock exercises where people in the cybersecurity team will play a role to try to penetrate somebody's system, or we send out fake mock emails to create a sort of a lesson learned. When you get nailed internally, it's kind of embarrassing, especially if you're an executive, but it's all part of that training exercise.
Apparently, the most common phishing email that, which is cyber infiltrated, it's a picture of a dancing cat.
A dancing
And
cat.
it's a dancing cat, and apparently that is the cartoon that most employees fall for. They click on the link, so it's a dancing cat.
I'm not sure, that's not good.
Continuing on the theme of technology, what do you see with exchanges and your own organizations using blockchain technology? Who's doing more? What are you doing?
I mean, I say, for us, we're not at the forefront of trying to, of groundbreaking blockchain trends. I'd say the one particular area that is of interest of us, and I think the industry at large, is really on clearing and settlement. Currently in equities, you have a multi-day settlement cycle, T+3. There's a lot of companies out there that are trying to really not only bring it more towards real time, but even solve issues like fail to delivers around stock loan and shareholders of record. It's a lot of very antiquated, frankly, practices that are still underpinning our industry. And I think
I would love to see blockchain being used for proxy voting purposes, for example.
Yeah.
So from our perspective, we think about blockchain as a platform and smart contracts and some of the related technology as being able to transform and disrupt private markets from issuance all the way to clearing. So we look at these less liquid, less transparent, less automated markets where there's many intermediaries and there's a lot of friction. And so it's not cash equities, but it's these markets where we're really interested to see what kind of profound effect that blockchain and smart contracts can have end to end, and creating it native. So doing it native, not just doing it from a tokenized perspective.
So Tal, are you doing something there with your private markets?
Yeah, so our private market was actually built on blockchain.
Right.
And so then this is about 3 years now. We've had a platform where it didn't require the same scale and performance. So if you're building a trading system on blockchain, those that know, you're not going to get the same kind of performance scalability off of that. But when you're talking about private markets, there are different needs. There's a need for a clean audit trail. There's a need for immutability. And that's where blockchain and smart contracts really drive some value. But really, when it comes to blockchain and smart contracts, it's when you combine that with other technologies that you unlock a lot more value.
We're right in the middle, actually, of a benchmarking exercise, and so which has not yet been published. It was conducted at the end of August, so the numbers are reasonably, topical. And we've done a couple of them just to understand the landscape for our members. And 17 of our members put their hand up and said that they were exploring DLT. And that obviously, and there are about 8 of them who are in proof of concept stage. And of them, let's say like the Australians, ASX, they were early adopters. They're looking at it for their CHESS, their post-trade system. You have a variety of different models. You have SIX, the Swiss, who are building their own digital exchange. Deutsche Börse, the German exchange, has gone that route too. The Malta Stock Exchange, Malta is in itself trying to be the kind of the blockchain center of the world, is going a slightly different route. They're having 2 JVs with two of the largest platforms. And then you have members like NASDAQ, for example, who have technology in their DNA, and they're doing kind of a lot of applications, et cetera, around it. And then you have the CCPs. So at our recent meeting, OCC actually presented on how they think about emerging risk from emerging technology. So you see actually quite a lot of activity in the space, all with different models. It'll be interesting to see once we actually see like a full-blown exchange. So far, we've seen applications around the industry as opposed to kind of an actual exchange emerge. I think that in general, the conversations around DLT have been good for the industry because it's made them think a little bit about how they can differentiate themselves. And I'm speaking partly of the fact that every DLT platform has called itself an exchange. And from a reputational perspective, if you look at every crypto asset platform calls itself an exchange. So every real exchange in the world has actually sat down, I think, and thought about what it means to be an exchange conceptually, and what is the value that regulated market model can bring and deploy in the DLT.
Yeah, and can I make one point on that, because she just raised something that's important. So the way to really unlock and unleash the power of blockchain is to bring the regulators along. So if we're not bringing the regulators along and we're not educating them and we don't care about investor protection, we will never get to the point where adoption in the institutional sense of the word gets to where we would like to go. So when you talk about exchanges who are really retail brokers or custodians, there's a concern still. There's a concern from the regulators that they're not being brought along, not being educated, and either is the government. And if we don't do that, we have failed in really bringing this new technology into the market.
Yeah, and we at Georgetown are trying to play our small role in bringing the regulators around, right? So some of the events that we do, there'll be closed door events. There'll be smaller events where people can speak up freely. And there's a lot of concern that maybe the US will get left behind. And countries like Singapore and Australia, a lot of countries are really moving ahead, even China moving ahead in a lot of different ways. So talking about crypto, is anyone doing anything on crypto?
Well, we started a couple years back, really just on listing futures on crypto, and but the market is so fragmented. So really, when you list so we listed futures on crypto that was settling in one of the exchanges. The challenge with crypto futures is the market is so fragmented, and which prices are using, which exchanges should you be using. So we kind of actually retrenched and delisted our future. The other area that we're focusing on with crypto is just on ETFs. So SIBO, we list ETFs, and there's been a lot of products trying to come to market. And you mentioned really the U.S. really being behind in crypto and maybe some and blockchain, but it's really on getting our regulators comfortable with basically ETFs always have to point to a regulated market, and given the state of crypto trading in unregulated markets, that's kind of the tricky situation that we're in.
Yeah, from our perspective, we still think it's early days in crypto on the future side. We've started to make investments more on the stablecoin side of the house. So we see disruption on the payment side. So we invest in a company called Finality, and they have utility settlement coin. And so we see stablecoin and digital currencies as having a place in the world as central banks start to think about digital currencies and what they mean to them, and how it helps from an OTC bilateral perspective really manage risk for very complicated transactions that otherwise require a lot of movement in funds and a lot of intermediaries. So that's actually where we've been spending a lot of time in the last year and a half.
So different regulatory jurisdictions actually look at it quite differently, as you're aware. So for example, China's gone one route. And that you will find affects obviously the market structure specific to each jurisdiction. So in the US, we have there's a lot of innovation, and it feels like it's around product, right? Because crypto is essentially emerging as a new asset class. And you don't have, that in itself is not new. You have asset classes, but they don't emerge that often, maybe every decade or so. The other aspect about crypto that has been really fascinating, especially I think you were talking about the future of work, is that it has brought a generation who were disenfranchised with capital markets, who viewed markets as a pejorative phrase, and they're suddenly interested again in the concept of markets-based financing. And that's obviously a wonderful opportunity, not just for the exchanges, but for everyone in this room. So you're almost seeing a sociological mindset move. I would say, I'm not going to say it's millennial because we say different things, but people are interested, people are beginning to trade, have traded, and it has reinforced their interest in markets-based financing and reinforced the importance of a regulated market.
Our students here at Georgetown, we've been very, very strong in finance, I would say, especially our undergraduates. Very large proportion of our undergraduates, not just in the business school, but also our Georgetown College of Arts and Sciences, our School of Foreign Service, they end up going into the financial sector. But it has changed after the 2008-2009 crisis. And the students are really their interest is technology, innovation, doing good. So I'm hoping that what's happening in the fintech space will keep the students excited about being in finance, because at the end of the day, maybe I'm biased, but I do worry a little bit about if finance doesn't get the best and brightest, that's going to be a problem down the road. We need the best and brightest in finance for Main Street to work. It's not just about finance, it's the broader economy and the global community. Finance has such a huge impact. So I hope these innovations and technology, and then we're trying to think very carefully about what does it mean in terms of the skill set these students have when they graduate out of Georgetown. So are there one or two new things that you're doing that you want to tell us about without giving up any proprietary information, issues that you're working on that we'll see in a broad sense in the next year or two?
Yeah,
Go ahead, Dave, start.
We talk a lot about blockchain here, but there's just another technology that we're really fascinated with and have been doing a lot of work with, which is AI. And so AI, when it's combined with other emerging technologies like quantum and cloud, can unlock a lot of value. And from our perspective, what gets us really excited is it has the ability to transform our relationship and engagement with clients. It makes it much more personalized, much more intimate, and it does it on two levels, right? One is it allows you to transform large amounts or massive amounts of data into actionable insights. So it mobilizes data in a way that allows you to talk to your customers about their experience in the markets in a way that you couldn't do before. The second is it's going to lead to a shift in the way that systems are designed. Right now, most of our systems that we employ are rules-based, and rules-based systems have inherent biases in them. And when you think about AI, it has the ability to eliminate those biases, create a learning system that's able to detect new relationships within the system, and over time improve, and not fall victim to those biases that today's systems do. So when we think about that, we get really excited, and we have two applications of it today. One is on the market surveillance side, kind of an obvious place to start, smarts. And so its underpinning is AI, where it allows us to identify market manipulation and detect new trends there. And then the second area in which we're employing AI is in index product creation. So it can create better, smarter products that are more interesting to end consumers and investors. So that's a technology we spend a lot of time thinking about, working with. And once again, we don't look at it in isolation versus other technologies.
Tal, what does that mean for the talent pool, the people that you're hiring, and the skill sets needed?
It's a great question, because we have this discussion at NASDAQ quite a bit in terms of we want to hire the best and the brightest, and we compete with a number of tech companies for those individuals, for data scientists and the like. And so if in 10 years we're sitting on the same technology, a few things might happen. We might lose all that good talent. Two, we're probably overpaying for it if we're not advancing our technology. So to the extent that I'm using technology that's 10 years old, either they're gone or I have to overpay them for their skills. And then three, we're not embracing new thinking, new perspectives. And that's really, really important. So we can talk about that from a diversity perspective, but we think about that tied to the way that our technology ethos, the way that we think about technology over the next 3 to 5 to 7 years.
So I would just say, because it's very topical on the skills that we look for, due to the quantitative nature of investing, everything is rules-based, how ETFs are constructed, indexes are constructed. The resumes that are most attractive to us and what we're working on is, people who have mathematical, even physics, any type of quantitative discipline. And you look at our customers, JP Morgan, Goldman, every article you read about the new traders are quants, and they're actually getting Series 7 license. So it's really, we're seeing the culmination of the convergence of applied math fields and bringing it into the exchanges now.
Yeah, we are trying to train our students here at Georgetown that they have the technical, but they also have a broader perspective so that they can put that data and the AI in perspective.
So I'm going to put two issues that we haven't discussed at all, actually, to my surprise, in this session. And I don't know that they are necessarily hugely new, but I think that they're both things that we're going to be thinking and we're living at the moment. One is what the regulators refer to as market fragmentation, and what we at the WFE refer to as regulatory coherence or dissonance. And it's kind of a macro theme, but it's an important one because the world that we are living in is fragmenting from a regulatory environment. It is a geopolitical conversation. Everyone in this room is affected by that. You know, whether we're talking about Brexit, whether we're talking about the Swiss-EU relationship, you know, whether we're talking about US-China, whether we're talking about just different parts of the world. You know, India and Singapore have a disagreement about index licensing data, for example. So it's a world that we live in, which from a geopolitical perspective is going one way, whereas the rest of us, for the last 40 years, markets have been more global, right? We have all driven towards the concept of, you know, cross-border, you know, global markets, you know, the benefits of, you know, being able to connect and interconnect. Technology has enabled us. So from a practical perspective, the world that we live in is changing very profoundly. There is nothing any of us can do about it. And we have to, as market infrastructures, navigate that change. We have to navigate that change for the customers, We have to navigate that change for the future generation, and we have to navigate it from the perspective of systemic stability and resilience, because that's the core mandate of the regulated market infrastructure. So that's one. And then the second one, if you allow me to put another one on the table that we haven't discussed at all, is really about the fundamental role and value of the market infrastructure. And that's both exchange and CCP. So what do they really do? You know, why are we still relevant? What do we need to do to ensure that we still are?
Yeah. Both really important points, and kind of you touched on what is the purpose, capital raising, entrepreneurship,
Exactly.
job creation, what are we really contributing to society? So how about with that, we open it up for questions for the panel. Please come to the mics here. There are mics on both sides, if you can come to the mics, and briefly introduce yourselves, and if we keep the questions brief, then we can get more of them answered.
My name is Hirak Christian Kim. I'm the president of Georgetown Collaborative Diplomacy Initiative, and we are the primary group working on alternative diplomacy at Georgetown University to advance world peace. I was at a conference, academic conference at Liverpool Hope University, delivering my paper on Jewish studies. I'm also an expert of Jewish studies. And I talked with people in the street about Brexit. And one of the things that I noticed is many people are very unhappy with the fact that it has not happened because they voted for it 3 years ago. And it seems like Britain is being hurt because they're in a purgatory. They're neither after Brexit or really before Brexit. They're kind of stuck there. And you mentioned about how we are affected by things that go on in markets. So can you quantify how Brexit is affecting financial markets and policies in ways that we can understand?
So I would say that nobody can quantify Brexit. It hasn't happened yet. I think there have been a range, like there are a raft of estimates of what it's done to the UK economy to date, and both kind of from academic research and also from just kind of anecdotal qualitative research, right? Property prices are falling, the currency is down, people are spending less, inflation is rising, all the classic factors. I don't think you can quantify it. Brexit hasn't happened. Till it happens, or if it happens, I don't know. And we won't be able, I think, to quantify the impact really for the next decade, whether it happens or not. The last 3 years have been years, we're based in London, so I speak from the perspective of someone who lives there as well. Every exchange comes through, every one of my members comes through London to do business. They don't stop in London to do business. They go on to Frankfurt, they go on to Paris, they go on to Luxembourg, they go on to Dublin. There are multiple financial centers in the world, many of which are seeking to take London's role as that international financial center, but we won't be able to quantify the impact, I'd say, for a decade.
Thank you.
Yeah, the next question.
Good morning. My name is Juan Echeverri. I'm a director at FINRA. There are a number of new entrants that are kind of waiting to enter what's already a very crowded equities market. Is there anything in these new value propositions that you guys think, oh, that's a great idea, or oh, that's marginally better than what's currently there?
I think that, it certainly, the latest Form 1, which is the application to become an exchange from the members exchange, it was very plain vanilla. But to be expected, your fastest path to getting approved is to not do anything totally different, try to get approval with the basic plain vanilla, and then you try to innovate from there. I will say that everybody wants innovation, but the current regulatory regime that we operate in, which has a lot of benefits for the end investor, regulation NMS, really creates a little bit of a rigid structure, is that it's sort of the old, you can have any color you want as long as it's black, from the famous Henry Ford. So competition is a great thing, and you're never going to see SIBO saying anything about too much competition or too much fragmentation. NMS should, technology, the power of technology should allow for the seamless transfer of risk at the touch of a button. But are the benefits, or I should say the negative externalities of fragmentation, does that outweigh the benefits? And I think competitive forces should drive that answer.
Yeah, please.
Hi, my name's Charles. I'm not going to comment about Brexit, you'll be pleased to know. I'm interested, Professor, that you mentioned about governance and corporate governance. And one of the concerns, and there's obviously been picking up with a story yesterday, but it's not limited to that, in the company of Under Armour. But there's been lots of companies whose corporate governance have been, how shall I put it, somewhat lacking, but to be specific. I'm interested in what the panel think that the exchange's role should be in making sure that the right actors are participating to provide things. And there's been scandals on both sides of the Atlantic with people, how shall I put it, gaming their quarterly financial returns. I'll use Under Armour because it's a topical one. But until people actually take serious the integrity of the markets, you're more likely to get these actions. And noting that the UK, one of the few countries in the world that, as a result of the financial crisis, have improved and taken up the individual accountability for individuals to be fit and proper purposes. Should there be a greater role for exchanges to make sure that individuals who are performing roles such as the chief executives and chairman, and should there be actual clear separation, as there is in most of Europe, between the roles of chief executive and chairman of boards, and people who revert between them, and when scandals occur, split the role and then suddenly become, I become a chairman now. And will governance and risk management actually occur?
Yeah, role of exchanges in corporate governance.
Yeah. It sounded more like a statement than a question, but let me try to take it from the perspective
it was, but I've said,
yeah.
Should there be more greater?
Yeah, and it's a fair question. So exchanges do have a role, and a big role in that, and it ties back to what I said about ESG, which is there needs to be education and awareness at the board level, and with our issuers, we need to make sure they understand what ESG means broadly, which, by the way, is still being defined in some sense of the word. And it's moving from a qualitative to a very quantitative set of metrics, by the way. So ESG and governance and how we think about it is moving to a very quantitative set of measures. And for CEOs, and make sure that they have better engagement with their investors, we need to play a central role in that. Now, do we dictate how that should look? Well, that's a tough question, because we're trying to bring companies to market, make sure we're availing them to the public investing community, and they're aware of what they're buying and what the risks are. So disclosure, making sure that there's proper understanding of the economic rights and the governance rights that you have with any share that you may own. And so we play a role in that. We're going to continue to grow our presence in that, and we're going to try to make sure it's a balancing act, because the other side of the coin is if a company doesn't feel like going public, they can just stay private. And does that benefit investors at the end of the day? I'm not sure.
We have time only for one last question, and I'm going to be a little bit biased and give that question to our undergraduate student from Georgetown University. So Sankalp, please come forward and ask your question. Others, I know you have questions. Our speakers will be around, so please wait. I do want to make sure that we give our undergraduate student here an opportunity to ask his question.
Yeah, sorry to steal the mic from you. I'm Sankalp Panigrahi. I'm an undergrad student here at the McDonough School of Business. The three of you touched a little bit upon cryptocurrencies and blockchain and how the U.S. is relatively behind in that space. And Mr. Harkins, you mentioned that the SIBO had to actually pull back their Bitcoin futures. So I was wondering if the three of you could speak a little bit about the specific developments that you would have to see within the cryptocurrency space before deciding to add back futures, options, and other crypto-oriented derivatives back to your exchanges.
It's a great question. To keep it at a high level, I think, we look at the SEC as partners in this initiative, and I think a lot of their questions and concerns and what they need is really transparency around, especially if we're talking about an ETF. We believe that if Bitcoin ETFs come to market, that's a game changer, because that gives really on all the wealth platforms, all of the retail brokerage platforms, at the touch of a button, the masses to have an ability to invest in crypto. In order for that to happen, I think we need to be more comfortable with the underlying markets. You mentioned that all the underlying markets call themselves exchanges, and that is a very loose use of the word. So there's the crypto exchanges. There's some really good ones, and there's some really, really fraudulent bad ones. And so I think it's really about getting comfortable with the underlying markets and the ability to surveil and prevent fraud, and I think we'll get there.
Brian,
Thank
just
you.
as your industry association, may I say gently that there are currently no crypto exchanges in the world, because I believe as an industry we should be thinking about exchange almost like a legal phrase. And there are lots of platforms, and they don't do what SIBO or NASDAQ does in terms of market integrity.
And investor protection.
Yes.
Please join me in thanking the panelists for a great discussion.